Hi there, my name's Chris Weston. I'm head of research here at Pepperstone, and we're going back inside the gold market. As good as gold is the title of the video today. If you find yourself liking it, please hit the like button. If you want to subscribe, then that's fantastic. And if you want to leave a comment about anything you've heard today, whether you agree, you disagree, whether you want to give your own views about what's going on in this crazy world of finance at the moment in capital markets, please do so. I'd love to hear from you. I'd love to reply back and be part of the conversation as well. So do leave a comment if you want to leave some and leave your own views, and that would obviously be really appreciated. But these are tough markets to trade. There's no doubt about that. I don't think trading's ever easy, but I think when you're at the mercy of headlines at the moment, and a lot of them around geopolitical events, it just makes life very, very difficult indeed. Try and keep it simple. And I think, when people are unsure, they do what they do best and they hedge that exposure. They go long crude futures, they go long gold, they've shorted risk. But for me at the moment, one of the things that's on the central radar, which we'll come to in a second, is what's happening in the Russian ruble. I think that's been a pretty good guide as to how people have sort of making sense of the different headlines. And there's a lot of misinformation, which makes life very difficult. As I say, I think if people are very good nowadays at pricing risk around central bank actions. This idea that the Federal Reserve are going to be raising rates 5-6 times this year. They're going to start balance sheet contraction from around June, July time. I think people are okay with what's happening in the Bank of England and the Bank of Canada, where they're going to be going aggressive asset sales, not just passive balance sheet runoff, but actually selling their bonds that they've accumulated to commercial banks. I think people are okay with what they're hearing from the RBA and the Riksbank, that they're behind the curve. And we can price risk around these situations. We've become familiar with interest rate pricing and the connections they have with various asset markets, and we can wind ourselves and our investments into parts of the curve. People have been rolling into quality defensive areas. They've been rolling out of high beta and really going into those quality defensive areas of the market. I think people have been looking at credit markets. People have been looking at political events over the year. And I think we've become better at pricing risk around politics. But I think people are still very poor at pricing risk around geopolitics. Our case studies, the sample size that we have, are obviously less numerous, and therefore our ability to learn becomes lower, and we hedge our exposure where we can. And a lot of those hedges are being unwound at the moment. If we have a look at what's been going on in markets there, I've been looking very closely at what's been going on in dollar ruble. Now the problem with dollar ruble is that it doesn't trade 24 hours. So you can see that we've got this kind of scatty looking chart. We've got this idea of breaks that have been taking place. But what you'll tend to see is when dollar ruble is moving higher, that's obviously a reflection that we are seeing a deterioration in sentiment. There's negative headlines coming through. The ruble will sell off. The MAEX in the Russian stock market will sell off. And what you'll tend to see is gold being sought as a hedge. Oil prices will be sought as a hedge. You'll see people buying volatility structures. People will be shorting equity markets, shorting risk more broadly. And when you see dollar ruble moving lower, you'll tend to see a situation where some of those hedges are unwound. People take some of that gold length out of the market. You'll see oil prices trading lower. I mean, we've got other factors that are playing into the oil market at the moment. Or what's going on with Iranian nuclear talks, I think, is really important as well, and that could cause more oil to come into the market, and that supply could see oil prices trade lower. That's something that we are watching very closely in the short term. But you can see here, while it's a pretty messy chart, when dollar ruble trades low, we tend to see gold prices trading a little bit lower as well. Now, in terms of the actual chart itself of dollar ruble, I'm going to quickly go to my FX charts and go to EM that I've got here, and I'm going to have a look at what's happening in dollar ruble on the daily. Let's take this onto the daily time frame, because you can see here when dollar ruble trades higher, you can see these massive range expansions playing through. It can be a very volatile currency pair, but when we saw it doing that, then effectively equity markets were trading low. We saw the VIX trading into 30%, oil prices traded into $95 in WTI, and gold prices were trading into sort of 1877 into 8079, those kind of areas as well. Now we've made a lower high. A bit of indecision there, but it's kicked lower. Now, if this trades lower back down into this neckline, effectively into this strong support in 74.26, as the ruble strengthens, that will be a reflection that people are unwinding some of these geopolitical headlines and the hedges that are coming through. I'm not going to try and predict what's happening because it's very difficult. And as I say, I'm not an expert in this, and not many people are, but I will use this as a central guide for risk in the short term. If I'm trading gold, if I'm trading all these assets, then I'm going to be watching dollar ruble with very, very keen interest indeed. If it breaks breaks through these lows and trades lower, then I think gold prices are going to kick lower, and I think I'll be looking to buy or sell gold or short gold in the strongest currency, as always do. If this kicks up, though, if we sort of trade back in through 77.50, that's obviously going to be a perception that things are breaking down, that we're going to see sanctions being placed on Russia, and they may look to counter on that on its own initiatives indeed. And of course, that's going to be a situation where gold prices are going to go back higher. We're going to see a situation where risk will come back out of the market and oil prices will reverse and go back higher again in the short term. So I'm watching this dollar ruble cross very, very closely indeed of what that means for the gold market. Now let's have a look at sentiment towards gold, because I think this is really interesting in itself. Now, first things first is let's have a look at 1 week implied volatility in the gold price. You can see that's gone to 14.4%. So this is a one standard annualized standard deviation number. Effectively, this tells me when it's going up that people are expecting greater movement in the gold price. This is really important for everyone out there, because greater expected movement means that you potentially have to have a wider stop loss playing through. You're going to see that in realized volatility and things like average true range and your standard deviation and all the other factors that you look at with realized volatility, such as Bollinger Bands. But when I'm looking at what's expected, this is a more forward-looking indicator. People use this in options pricing to buy volatility, straddles and strangles and those factors as well. But you can see this has been moving higher, and that means that the market is expecting greater movement up or down over the coming week in the gold price. And you can see that's now at the highest levels for the year. If that can get above 16%, then we are going to see much greater movement. That means that we're going to have a wider stop and a smaller position size in that situation if we want to stay in the game. What we can also see is 1 week and 1 month risk reversals. This is a really great guide for sentiment to me. They're saying to me that this is the skew of call volatility, 1 week call volatility minus 1 week put volatility. So if this is going up, the market is effectively betting that if we are going to see a move in gold, it's going to be a more pronounced move to the upside than if we were to see a move to the downside. It's a really good guide about semantics and what they're seeing there. And the fact that this is now positive, you can see it at 0.75, is the market is saying if we're going to see a bigger move in gold, it's going to be a more pronounced move to the upside when we do see a move. And you can see that we are pushing into the sort of the highest level since November. We're not at any kind of extremes where we're seeing euphoric conditions, which can be a contrarian indicator, but the market is positive on gold in terms of movement. Let's have a look at positioning. We can see that 84,000 contracts is certainly not extreme by any means. It's quite nuanced. It's quite neutral in some capacities. It did build a little bit from last week, but not really anything too aggressive in terms of managed money in gold futures. If we got up to say 300,000 again, then I'd be looking at very, very extreme levels where the market is very, very long. We're nowhere near that level at the moment. So we're in a quite neutral capacity in terms of what we've been seeing there. My model that I like to look at is gold relative to its 50-day moving average. I like to use that because so many people do use it as a trend filter. The 50-day moving average on gold is moving higher. But what we want to see is when we see a really impulsive, explosive move up in gold, does it becomes too extrapolated from that 50-day that we can take mean reversion positions, that we think to ourselves that it's that elastic band's just been pulled a little bit too far. Now we're 2.2% above the 50-day moving average, which is a positive sign, right? I mean, it shows that prices are moving in the right direction, and it's become a premium, but it's not at any kind of extremities. If we got above 4%, I'd get a bit concerned, and I'd maybe start lightening my long positions just based on this model alone. If we got above 7.6%, then I'd aggressively be looking at mean reversion positions. We're clearly, well over 5 percentage points above that. But you can see statistically, when we get above 7.6%, which is 2 standard deviations from the longer term average, that's the level that I'll be looking at mean reversion. So both models, whether we're looking at options, tell me to be quite positive at the moment in terms of where we are relative to 50-day. Not concerned at all. That's positive. And also positions quite neutral as well. Now let's have a look at what we're seeing actually in the gold market, because this is what we do. I'm going to immediately go to what's happening in the US dollar gold price. First of all, we can look at some of the other ones in a second, and I want to have a look at the weekly positioning, because what we can see, we've got this cup and handle in play. We've broken through. You've got the this series of lower highs playing through this downtrend. Obviously, we've now broken through that. You can see last week we closed firmly above the downtrend. It got a lot of attention in social media. Everyone was talking about what was going on. We got this triangle pattern in play, which projects nicely higher. Now that's complete, but it now needs a bit of work. This is very positive stuff. This is probably why the options market is priced the way it is, and expecting higher moves to the upside. But if we have a look at the weekly chart for oversight, we've got a breakthrough there. That was great. We kicked higher. We made a higher high, but we actually found sellers coming into this November high as well, 1877. We've got what's shaping up to be a pin bar reversal. Now, obviously, there's a bit of time. We want to see what happens by the end of the week. At this juncture, we have a pin bar reversal in our hands, but we've still got 3 days still to play. Obviously, if we see price kick back below 1845 through the week's lows, and then we get back below this downtrend, that could be a failed breakout. That could be a bearish signal in itself. But then we come back down into the former uptrend, and we really want to see price hold 1783. If we get a close below 1783, I'm going to be taking much more bearish positions in gold. I'll be looking for that to trend lower. Maybe that's going to be higher real rates. Maybe that's going to be a complete removal, a really strong diplomatic relationship building between Russia and the Ukraine. I doubt that's going to happen, but I'm no expert, as I say. But that's really where we are at the moment. We saw this market kick up. We've broken through that. At the moment, we're holding this downtrend, or this former downtrend, but we've got a bit of indecision there. We've got this reversal potentially playing through. So we've got this 1845 level very much in the play. If it breaks through there and we create this failed break through the downtrend, then we were at the mercy of coming back down into 1795, perhaps down into 783, where shit gets real. And I think that's the level that we need to be looking for. On the other hand, and this is what I think possibly could happen, and if it does, then I'll trade this, and I'll actively trade this. If this now holds this high, which it's doing at the moment, and it kicks back up, perhaps dollar ruble therefore moves higher, I will go along with that, and I'll look to increase length. I'll look to go long. And if we can break back above this 1877 level, I'll add to those positions. Now, some people say, why don't you get your positioning right? Why do you add to winning positions? Why don't you just get your positioning right in the first instance? Why would you look to pyramid this trade? I think there's some truth to that. But what I want to do is when the market proves me to be right, I'll look to add to this. So I'll start with a reasonable position. And as this starts kicking up, I'll look to add to those positions because the market is saying to me that it's doing more of what's working. I know a lot of people disagree with that idea, and I'm fine with that. But I think at the moment, start with a position. If the market kicks up, I'll look to add to that. And that's certainly if we break through 1877. So really, I mean, you've got this triangle in place. You've got this broadening megaphone. You've also got this cup and handle. If we get a break through 1877, I just can't describe just how positive that would be in that situation. But we have this pin bar reversal, which could play out. So we are, a bit cautious on that at the moment, but we're just watching for price just to push us into that trade. One trade that has been working quite well has been gold in yen terms, because obviously the yen's been the funding currency that everyone's been using. So when you're looking to go long of gold, you want to do it in the weakest currency, and that's been euro and yen recently. Now what we are seeing is after this break, we are seeing a bit of indecision again. We've got this pin bar reversal potentially shaping up. Could this be our short-term high? That's something that we are watching very closely. Gold in euro terms has got another similar pattern if we look at it on the weekly. I know a lot of people don't trade off the weekly, but you get the oversight, that rhythm, the feel, and the structure that's taking place. So we've got this pin bar reversal. If this kicks back below 1625, I think gold in euro could be a better short than other trades going forward, because it would probably mean that the euro is strengthening, playing through, and maybe we get a move back into 1580. That could be a short position to take out. Gold positions in Aussie dollar terms, another one there as well. So really, a lot really depends on what's happening in the underlying currency there as well. So, I really want to see what's happening in gold in US dollar terms. So that kick up. But these two are quite interesting. Gold in euro and Aussie terms, you've got a pronounced pin bar reversal that potentially could mean we're going to see a short-term top in that. So let's go and have a look at what we're seeing in the currency market. Immediately, let's have a look at the daily chart of Aussie dollar, because we got this trend break that took place, but then the buyers stepped in aggressively. You can see this huge wick taking place. There's very, very strong demand. It was looking pretty dicey for a second in Aussie dollar, but we came lower, and the buyers have stepped back in. The next day, yesterday, we saw a really strong move coming through in China. I know we saw a big weakening picture coming through in iron ore futures, but if you look at the equity market, it had a strong rally, and potentially we're going to see that follow through today. And the Aussie dollar is obviously correlated to what we're seeing in the Hang Seng and the CSI 300 in China. But we've made a higher low. And we just look like we're kicking through. So if this moves a little bit higher, I think gold in Aussie dollar terms may be a place that we may see some further downside. We may see some follow through downside in terms of that pin bar reversal. If we have a look at euro dollar, well, we obviously had that strong rally moving up into this double top into 1485, and we've just been trading down in this channel effectively. We're making lower lows and lower highs. We've stopped into the 50% retracement level. We saw some buyers. It closed back above that level, and we're just chopping around at the moment. You can see these short-term moving averages are moving sideways. There's no real trend, but if we get a move through these highs of 113.69, that could be an indication that we're going to see long euro dollar positions working a little bit better. And I think in that situation, gold in euro terms may follow through and trade a little bit lower. And I think if we're looking to go long in that situation, then long of gold in US dollar terms may be a better trade, because of course, as I say, you want to be long gold in the weakest currency. Now, does that mean we're going to see it in dollar terms? Obviously yet to be seen, but I actually quite like what I'm seeing in Aussie dollars, and so I probably wouldn't be looking to go long of gold in Aussie dollar terms at the moment. I think we can get better plays playing through. So this US dollar is an interesting one. We've got a lot of focus on what's going on in rates at the moment, but if equity markets continue to feast off what they're seeing in dollar ruble, then I think that we're going to be looking at what happens in terms of that equity situation there going forward. So I've got dollar ruble very much on the trade. Let's go back to the commodity trades, as we can see here in terms of gold. We've got this outside day reversal, this engulfing coming through, this follow through. So taking a little bit of a cautious stance at the moment, but if it does kick up, and that's obviously going to be a reflection of what we're seeing in dollar ruble, I'll probably go along for the ride. But we are starting to see in some of these weekly charts a bit of indecision playing through to push this price higher. And if we do see dollar ruble trading lower, then I think gold prices may continue to trade a little bit lower as some of these hedges are removed. So keep that dollar ruble very much on the radar. I think that's going to dictate a lot of sentiment in the short term.